but also that they're going to start divvying up other people's pies to pay for Melvin's share. Moon Platoon, every single day I have to grab the Glenfiddich and say, when is the squeeze? And yet, we continue to trade sideways. Well, let's jump right into C-Dig's newest DD. Give him a thumbs up. Make sure that you understand that he was the one who wrote this DD. He is not a financial advisor. Go into the description and find his DD description link and then head on over and give him an upvote. Pancake Courtney just joined as a member of the YouTube channel, which means you can as well. All you need to do is press that join button next to the subscribe button, where we are heading off to 100,000 subscribers in the near future. Would like to see you join us. Let's cover why we're still trading sideways and why we haven't launched. This is going to be a girthy little DD full of little nuggets of helpful financial education. So the most important thing that you can do is just sit back, relax, and watch until the end. Here we go. We've made it through an exciting week of suspense only to end up with yet another day of sideways trading. I like to think about why we have not launched yet based on the bits and pieces that we do know. In this post, I'll be rehashing some of their earlier posts for folks who haven't read them and also examining their earlier thoughts in the context of the information that we have come across over the last 2 weeks. One of their favorite topics in science is black holes, okay? So how do we know where to look? Even though we can't see a black hole and even though it could be millions of light years away, we can observe how bodies of mass interact with it, how it affects the space around it, the energy that is dissipated from the black hole, and other signatures of its existence. So the GME mother of all short squeezes is a black hole in more ways than one. We can only speculate on what is happening based on how the different entities in the system are interacting. So what exactly are we theorizing here? Well, the general sense is that if there is a chart with a history of short squeezes, let's say that that was the January squeeze, that is the March squeeze for GME, and now we're on the path to wherever. It doesn't really seem like we're going anywhere, but slightly downward and to the right, we can look at the signals that we originally saw. For example, the MACD passing over the signal lines each time right before the chance that we have for a short squeeze. Maybe the MACD crossed over right here every single time before the squeeze started. Right here, again, crossing over right before that squeeze starts. So there is a hole right around here that the black hole should fill. But when will it fill it? We're going to have to dive into this document to find out. Who are these other entities circling this black hole? Well, on the page 84, on this S4 filing for merger with Apex Clearing, we have plaintiffs allege that Apex, along with 30 other brokerages, trading firms, and clearing firms, including Morgan Stanley, E-Trade, Interactive Brokers, Charles Schwab, Robinhood, and Barclays, Citadel, and DTCC, engaged in a coordinated conspiracy in violation of antitrust laws. So, while this is alleged at this moment, what is clear is that some law firms believe that there's a case against multiple entities, including the DTCC, for conspiring to shut down the January 28th squeeze. So set aside that the idea that Citadel or the GME shorts alone can suppress the price of GME. If this were the case, we would not have had a January and February spikes in the first place, since Citadel and the shorts alone could have stopped it. Make sure I don't block Meatball here. As they mentioned in their previous post, rather than think of a situation as Citadel is shorting the market, or it's a battle between short hedge funds and long whales, the DTC, OCC, and SEC, then the shorts are preparing for the squeeze. So we see this vacuum right now where there should be a mother of all short squeezes on the way, and yet why is it that we cannot see it? Well, we're going to have to look at the other indicators around the black hole here. Literally every major entity in the global banking is entangled in this through the DTCC. Even the non-DTCC members are as entangled as they use DTCC members for clearing their trades. Once again, it's the money cartel. It's very, very difficult to be able to pass through the money cartel without fully seeing into what they want you to see. Looks like we're coming in on a cross section here, right? Apex Clearing, whether they're a member of the DTC or the OCC, they all are. How are they preparing? The fallout from this squeeze is that there are multiple DTCC members who are going to fail and default. These risky uncles that we have talked about before, right? When this happens, a DTC or corresponding subsidiary, hereafter just referred to as DTCC, will step in to manage the default through recovery and wind down procedures, which are documented in their membership agreements. During the squeeze, DTCC will intervene and provide immediate liquidity when a member defaults. In turn, DTCC will use their assets of the defaulting members as collateral for that liquidity. Those assets from the defaulting member will then be auctioned off to recover those loans. Let me explain this in animation. Let's say that everybody has a piece of this pie that makes up the DTCC, right? We have this piece, we might have this piece, right? So someone might be larger, like a big Citadel kind of character here, and we might have this piece from a Melvin or so, right? This is just the amount of assets they have. In fact, this is just a small piece of a much larger group of illiquid assets. If you guys remember the SLR rule, the supplementary liquidity rule, this required that we have this as a numerator over this as a denominator, or everything in blue over as a denominator, and that required that this liquid part be larger thanks to the pandemic easing up. So now that we have a good understanding of what kinds of money is on the table, this is the DTC's money, right? The DTC is the head of this cartel, and if, for example, a Melvin decides that they are going to do a risky business, they might lose out on all of their liquid part and then start to creep into the next part in terms of their debt obligations. That's how you default, right? That's how you start losing, and you can even experience this yourself if you get margin called as a investor or even as a as part of the bank. You could end up getting bankrupt, and that's one of the other options that you could see in your life that the hedge funds are starting to see coming up very closely in their rear view mirror. So from there, they are already deciding that some of these risky uncles, for example, these Melvins here, are going to now require to report their risky business a little bit more, but also that they're going to start divvying up other people's pies to pay for Melvin's share in case they are starting to make a scary but expected realization that when the squeeze happens, they're not going to have enough money to actually keep it safe, right? The entire market is at risk right here. So here is a little bit more of the verbiage from the actual documentation from 004. Let's talk about why this is interesting. There are generally three views on what is about to happen. One, the entire system and the banks are going to go belly up because of the scenario described in the Everything Short DD by Austin Tobit, right? He could not join on the day that he said he was going to come on because he is wanting this DD to be the best of the best. And it's going to be exclusive still to this channel. He's going to release it and he's going to talk about it here live. We're just going to have to give him his space because it's not going to happen today. Number two, the banks are reacting to increased liquidity requirements stemming from last year and the expiration of the SLR, which is something we just talked about. Number three, a few entities are probably going to collapse due to overexposed positions, and other entities are moving into position to profit from that collapse. A sense is that number one is a bit too extreme, having gone through 2001 and 2008, they have learned one lesson. The rich will not allow themselves and the system that props them up to fail because they're too dependent on the system to support their bottom lines and lifestyle. Now, that actually is one of the most important pieces to remember, is that if you are worried about the system overall, remember that they live on this ship too. And the rich are not going to let go of their lifestyles that easily. Let's see. So let's skip through a little bit more. They think it's a combination of number two and number three. What if, number one, you are a non-defaulting member, as in you're one of the good kids in the family, right? You're not a risky uncle. You're this red pie right here that didn't ever hurt anybody, that is not going to try and bankrupt GME or AMC. You're just part of the DTC because you need this insurance. You need enough money that the DTC is willing to pay on your behalf in case you ever end up in a bad situation. But now it seems like you are likely going to have to start paying for risky uncle's drinking and gambling problem. Now number two, you know that there's going to be member defaults, which you do. And number three, you know that there will be an auction for their assets at market discount. How would you prepare for this? Perhaps you'd have cash on hand to meet liquidity requirements and emerge from any collapse flush with assets. How might you go about this? So we have a couple of links to talk exactly about what Goldman Sachs, JP Morgan, Bank of America, Morgan Stanley are going to do. And then the curious case of the increased short volume of BlackRock's IXG ETF, which is a basket of finance and banking stocks. These are all resources that you can find in this DD. Furman Hassan, thank you for the super supporting the show and coming on the live stream. You guys can do it as well, right? It's perfectly free. What is important to understand is the difference between short interest and short volume. Squeeze Metrics white paper does a great job explaining this. So we have here, this means that whenever a market maker fills an investor's buy order, the MM is facilitating the trade by shorting shares. Thus, short volume is actually representative of investor buying volume. Okay? Furman is asking a question about Austin Tobit. Check the pinned comment in the live chat, or just scroll back to the very beginning of this live stream. The purpose of a market maker is to provide liquidity. Say you want to buy a bunch of IXG. So this is just a little bit more about the ETF IXG here. It's another signal about where the black hole is that we cannot see. How do they know that there will be a default, and who will default? Excuse me. There's a little bit of interesting text on page 12 on the 004 documentation. In light of observations from simulation of participant defaults and other analyses, the DTC's multi-member closeout simulation exercise. They used a computer. So they have an existing model that can simulate market conditions, and they already simulated the squeeze and the aftermath. So their assumption is that they're going to have some idea of the probabilities at which their member entities are going to fail. When they will fail, how they will fail. Basically, you don't know that whether or not they know. But it really sounds like that they have some pretty impressive algorithms to tell you when they're going to fail. Proposed change, a little bit more verbiage here that shouldn't be directly relevant to the question of why have we been trading sideways? What are we waiting for in terms of the mother of all short squeezes? What does this have to do with trading sideways? Finally, we get to the meat. 2 weeks ago, he posted the same DD because they were puzzled at why we're stuck in a monetary Lagrange point. And he stated then, what you can take away from this is that we will not see significant price movement up or down for the foreseeable future until OCC 003 and 004 are in place. You're literally fighting against all of Wall Street, even the GME longs. There are literally no point buying deep out of the money options. Hint, hint. If you play with options, those $800 options are not very helpful until there's a whiff of 004 and 003 getting close to implementation. We will keep trading sideways, borrow weight will be inexplicably low, volume will be absent, etc. until DTC and OCC members are protected and they let off the brakes. Okay, so we need to make sure that 004 actually has a plan to be instituted, which is the point of this update. I had to point out with the timing and coordination of the two prior drops that now we have a third set of data sets to consider. One, the dip to $120 coordinated with Q4 earnings. If you guys remember that, we were covering that live when the dip actually happened. The dip to $160 coordinated with the positive Q1 preliminary results and almost immediate return to stasis. And number three, the slow dip to under $40 possibly coordinated with number one, Melvin's Q1 results, number two, Sherman being denied his shares and now being replaced. If you guys remember that, George Sherman, the CEO of GME, underperformed and then were denied a good amount of his promised shares because he underperformed. He is a brick and mortar Home Depot kind of CEO, not an e-commerce CEO. Early discharge of their long-term debt, right? They are planning to be 100% debt free. And DFV's options being exercised. So it seems like we're back to sitting on a new Lagrange point and trading sideways again. So what here, Q4 events, right? Q4 results. We saw the earnings call really dropped us down to 120. Q1 preliminary results here. And then Melvin Q1 loss. We saw that they had a major loss. We reported that over the weekend. Sherman share surrender and step down. Early debt discharge and DFV exercising their options. As they stated before, they think that the variety of tools we see at play are all part of the arsenal being deployed by multiple parties coordinated to keep this strap down until the non-defaulting members are firewalled. The deep in the money calls, the dark pool trades, and all of it plainly visible to DTC and the SEC, yet no action is being taken. So If what about the share recall or insert catalyst, right? We're waiting for catalysts that are not the 004. If you are waiting for that, it seems like Mr. C. Diggs has a response for you. The conjecture has been that we will be waiting for 003 and 004 as long as possible because these two codify key changes to the OCC member agreement to contain the fallout of the defaulting members. Basically, they need to cut this ripcord before they can let the body go. Right now, they're just holding onto the body right now. This is the simplest. Ape did not understand this post. If you guys are in that camp, right now, the DTC has no ability to turn around and say, these are the people that are risky, these are people who aren't, and the non-defaulting members are going to have these privileges, and the defaulting members are going to have these privileges. This is the current way that this insurance money cartel works, is that everybody puts their money together, and then we'll just have to use some people's monies for some other people's. Before 004 actually gets put into place, we don't have the ability to have clear outlines of who wins and who loses, and that scares the DTCC. So they're currently waiting until that happens, so to push the ripcord and push the defaulting members out of the DTCC. Basically blows the auction process wide open. In an ideal world, BR and Cohen want to wait until 004 is codified to launch, and in fact, perhaps thought that everything could have been finalized by now and would want to ignite this launch sequence. SIG threw a wrench into this by objecting to 003, thereby pushing out its finalization, which would have been April 10th. Sets us up for potentially this week if 004 has also been finalized, but now could go out to May 31st. That's why we don't do dates here, right? If you guys heard April 10th earlier, then you would have been sorely mistaken and sorely disappointed. So what will BlackRock and GME longs do? Just as a quick note here. This is where it gets interesting. Here's Larry Fink, CEO of BlackRock on CNBC, talking about Reddit and GameStop. BlackRock knows what's going on at the highest level. So we've covered BlackRock's role in this in previous DDs. I'm not going to cover it right now, so you guys can go check it out in either this source post or go into the DDs that we've covered in the past here about BlackRock specifically. What happened on March 16th and why have we traded sideways since? Right, 003, notice of filing and immediate effectiveness for a proposed rule change to remove the requirement for participants to submit monthly position confirmations. So now they have to start giving it to us on the daily. Vicious.mob, sir, this is a casino. Good super chat. The key change is that the DTC participants were required to reconcile and confirm their records of their positions with the DTC's records of their positions on a monthly basis. Now it has to be on a daily basis. So this is one of the first rules that we've covered in terms of DTC making moves and helping us change the game here. And yet that lawsuit is still holding DTC as a defendant, as someone who has done wrong. And we can start seeing now that they are kind of like the lesser of two evils, trying their best to cover themselves, but certainly not guiltless. So after January 28th, all parties have a sense of magnitude of this event, but probably could not get enough transparency to make the right decisions. It's hard to coordinate illegal activities between members that are, so far away out here. So finally, I know we have gone through a great amount, but there's still verbiage on this DD about 004 that you should go check out. Too long didn't read. What should Ape do? Their conjecture is that in an ideal world, 004 is the key piece to get into place to redefine their liquidation of failing members. But we may now be pushing up against the calendar, and Ryan Cohen, GME, and BlackRock may be forced to play their cards rather than wait. Or they could be wrong and everything gets blown down tomorrow. So once again, C. Diggs, we've talked to him on Reddit. He was on board back at the 12th of April to come on the show. Maybe we'll have him on the show in a future live stream to just give a little bit more thoughts of why he is so darn bullish on the 004. But as a reminder, like a black hole, we cannot actually see it because even light does not escape, but we can observe how the mass bodies around it interact and how it distorts the space that it occupies. A beautiful analogy and a very well constructed DD. So once again, really quick, thank you for those of you who made it all the way to this part of the video. Thank you you for smashing a like. We're trying to get this video up to 1,200 likes so that the YouTube algorithm can be soundly defeated. And if those of you had already pressed that join button next to the subscribe button or the Patreon link, hey, that's why you guys get to see your names in the end of this video, and I will see all of you in the money.